Imagine this. Japan, the land of robots, bullet trains, anime, and some of the world's biggest companies. Toyota, Sony, Nintendo. A country famous for discipline, efficiency, and innovation. And yet, its money is weak. The Japanese yen is worth so little compared to the US dollar, the British pound, or even the euro. US dollar can buy over 150 yen. That means if you're an American tourist in Tokyo, your money stretches far. Hotels, sushi, souvenirs, all suddenly cheaper. But wait, shouldn't Japan's currency be strong? This is one of the richest, most advanced countries in the world. So why is its money so low in value? Today, we're going to uncover the secrets, the hidden reasons behind Japan's weak currency. And trust me, it's not just economics. It's history, it's psychology, it's strategy. By the end of this video, you'll understand why the yen is weak and why Japan actually likes it that way. Chapter 1. A currency that looks weak but isn't. Let's clear up a big myth. A low number doesn't mean a weak country. Currencies are not like Olympic medals where higher equals better. They're just units of measurement. Some countries choose big units, others small. Take Kuwait. 1 Kuwaiti dinar equals more than $3 US. Sounds powerful, right? But Kuwait is a small nation with just a few million people. Its currency is high because the government simply issued fewer units of money. Now look at Japan. $1 US buys more than 150 yen. At first glance, it feels weak, but that doesn't mean Japan is poor. Japan is still the world's third largest economy with world-famous companies and massive exports. The tiny yen is simply how Japan's money was structured. Think of it like this. Measuring distance in centimeters makes the numbers look big. Measuring in meters makes them look small. The actual length doesn't change. The yen is like centimeters, lots of small units. But here's where it gets more interesting. The yen's value hasn't always been the same. Back in the 1980s, $1 cost about 240 yen. Then, during Japan's economic boom, the yen became much stronger, at one point less than 80 yen per dollar. That was when Japan was at its peak power. Today, it has swung back the other way. The yen is weaker again, over 150 per dollar. So, while the smallness of the yen is mostly about design, the real story is how its exchange rate has shifted over time. That swing, from strong to weak, reveals deeper issues in Japan's economy. And that's where our mystery begins. Chapter 2. The Bank of Japan's Strange Policy. Here's where things get really interesting. Most countries treat inflation, the rise of prices, as the biggest danger. When prices climb too fast, people struggle to afford basics, so central banks raise interest rates to cool the economy. The US Federal Reserve does it. The European Central Bank does it. It's the normal playbook. But Japan? Japan flipped the script. For decades, the Bank of Japan, BOJ, has kept interest rates at rock bottom. Sometimes even below zero. Yes, you heard that right. Negative interest rates. That means banks actually lose money for holding excess cash. So what does this mean for ordinary people? If you put your savings in a Japanese bank, you earn almost nothing back in interest. A dollar in the US might grow a little in your account, but a yen in Japan, it just sits there. On the flip side, if you borrow money, a car loan, a house mortgage, the cost is extremely low. Borrowing is cheap, saving doesn't pay. This approach has a name, ultra-loose monetary policy, and Japan has been running it longer than anyone else on Earth. But every decision has a consequence. With interest rates near zero, investors ask a simple question. Why hold yen if it gives me no return? They'd rather move their money into US dollars, which offer higher interest. That flood of money leaving Japan makes the yen weaker. Think of it like a seesaw. On one side, the US raises rates. On the other side, Japan keeps them flat. The balance tips and the yen slides down against the dollar. But here's the mystery. Why doesn't Japan just raise its rates like everyone else? The answer lies in one word: deflation. For most countries, the fear is too much inflation. For Japan, the nightmare is the opposite: falling prices. When prices fall year after year, people stop spending. Why buy today when it'll be cheaper tomorrow? That mindset freezes the economy. Businesses earn less, wages stagnate, and growth dies. Japan lived through that nightmare in the 1990s after its famous economic bubble burst. Since then, the Bank of Japan has been terrified of deflation returning. So instead of chasing a strong yen or high interest rates, the BOJ's mission is different. Keep money flowing, keep spending alive, and avoid another economic ice age. And that's why Japan clings to its strange, ultra-loose policy, even if it means sacrificing the strength of its currency. Chapter 3. Japan's fear of falling prices. For most of the world, inflation is public enemy number one. Prices go up, the cost of living bites, and people complain about everything being too expensive. Politicians lose elections over rising grocery bills, but Japan lives in a different reality. Their nightmare isn't prices going up, it's prices going down. This problem has a name: deflation. It all started in the early 1990s. Japan had just lived through its bubble era, a wild period when the land prices, stocks, and spending exploded. Tokyo was so expensive that people joked you could buy all of California with just the land under Japan's imperial palace. But then the bubble popped. Property values collapsed, the stock market crashed, and the economy froze. Instead of prices rising a little each year, they started falling. At first glance, that sounds like a dream. Imagine your salary stays the same, but everything around you gets cheaper. Food, electronics, even houses. Who wouldn't want that? But here's the hidden danger. When people expect prices to fall, they stop buying. Why purchase a car today if you believe it will be cheaper next year? Why invest in a business if profits will shrink tomorrow? That hesitation spreads like a virus. Shops lose customers. Companies earn less. Wages stagnate. Jobs disappear. The economy slows to a crawl. And once a nation falls into that cycle, it's painfully hard to escape. That's exactly what happened to Japan. The lost decades that followed became a cautionary tale for economists worldwide. So the Bank of Japan made a bold choice: fight deflation at any cost. They kept interest rates at zero, even negative, to push people to spend instead of saving. They printed money through quantitative easing, a fancy term for flooding the system with cash. The idea was simple: make money so cheap that people feel encouraged to borrow, invest, and consume. But every action has a trade-off. Keeping rates low for so long meant investors abandoned the yen for currencies with higher returns, like the US dollar. And that's one of the main reasons Japan's currency looks weak today. In other words, Japan is sacrificing the strength of its yen to save the strength of its economy. To the outside world, it looks strange. But inside Japan, it's survival. The scars of the 1990s run deep, and the fear of falling prices still shapes every decision the Bank of Japan makes. Chapter 4. Exports, Japan's secret weapon. Now, here's the twist in the story. A weak yen isn't always a curse. For Japan, it can actually be a secret weapon. Why? The answer is simple: exports. Japan is a country that doesn't just consume, it produces. From the sleek cars of Toyota and Honda, and to the PlayStations and Walkmans of Sony, to the cameras of Canon and the machines of Hitachi, Japan's economy thrives on selling to the world. Exports are the lifeblood of its economy. And here's where the weak yen becomes a hidden advantage. Imagine you're an American buying a Japanese car. If $1 equals 150 yen instead of 100 yen, that same Toyota suddenly costs fewer dollars. In other words, the car is cheaper in your currency, even though the Japanese company earns the same amount in yen. That makes Japanese products more competitive overseas. This is why Toyota, Nissan, and other giants love the weak yen. Their profits skyrocket when they sell abroad. In fact, in recent years, Toyota has reported record-breaking profits, not only because of strong sales, but also because of the exchange rate working in its favor. But the benefit goes beyond cars. Sony sells electronics, Nintendo sells consoles, and Japanese heavy industry sells ships, steel, and advanced machinery worldwide. Every weak yen makes their goods look like a bargain to foreign buyers. And that's why some economists believe Japan quietly allows its currency to stay weak. It's not always a mistake, it's a strategy. But like all strategies, it comes with a price. Japan imports much of its energy, especially oil and natural gas, since the country has few natural resources. A weak yen makes those imports more expensive. Food prices also rise since Japan imports a large share of its wheat, beef, and other staples. For everyday Japanese families, that means higher bills at the supermarket and at the gas station. So who wins? Corporations and exporters. Who loses? Ordinary consumers. Still, Japan seems willing to accept this trade-off, because at the end of the day, the export machine is what keeps Japan's economy running. So maybe the yen's low value isn't a weakness at all. Maybe it's a carefully balanced strategy. A sacrifice at home for strength abroad. Chapter 5. The Shadow of the Past. To understand Japan's weak yen today, we have to step back into the 1980s, an era when Japan looked unstoppable. Back then, Japan's economy was booming. Its companies dominated global markets. Sony ruled electronics. Toyota and Honda conquered the car industry. Japanese banks were the largest in the world. In fact, at one point, Tokyo's land value was said to be worth more than all the real estate in the United States combined. The yen grew stronger and stronger. In 1985, the Plaza Accord pushed Japan to strengthen its currency even more to balance global trade. For a while, it seemed like Japan might even surpass America as the world's top economic power. But then came the crash. In the early 1990s, Japan's economic bubble burst. Stock prices collapsed. Real estate values sank. Families who thought they were wealthy suddenly found their homes worth half as much. Banks drowned in bad loans. Businesses froze. What followed is now called the lost decades. For over 20 years, Japan struggled with weak growth, falling prices, and a sense of stagnation. That trauma still haunts Japan today. The Bank of Japan remembers what happened when the yen got too strong and the economy overheated. So now every decision is cautious. Every move is designed to prevent another bubble. That's why Japan tolerates a weak yen. They'd rather grow slowly, steadily, and safely than risk another crash. It's almost like Japan carries a scar from the past, one that shapes its present. Every policy, every low interest rate, every acceptance of a weaker currency is a reminder of what happens when growth spins out of control. For Japan, the weak yen isn't just economics, it's psychology, it's memory, it's survival. Chapter 6. The Global Game. The story of Japan's weak yen isn't just about Japan. It's about the global game of money, where every currency competes for power. Let's start with the king, the US dollar. The dollar isn't just America's currency, it's the world's currency. Almost every country uses it to buy oil, to settle international trade, to hold foreign reserves. When financial markets get shaky, investors rush into dollars because it feels safe. That safe haven status gives the dollar natural strength. The yen, in comparison, doesn't play at the same level. Yes, it's respected. Yes, it's used in Asia, but it's not the global boss. That makes it more vulnerable when investors have to choose between the dollar and the yen. And most of the time, they choose the dollar. Now add another player, China. In the past, many Asian countries looked to Japan as the region's economic giant. The yen had more influence, but today China has taken center stage. Its economy is the second largest in the world, and its trade footprint stretches across Asia, Africa, and beyond. Many countries now trade more with China than with Japan. That shift has weakened the yen's importance in the region. So where does that leave Japan? Instead of trying to fight for global currency dominance, Japan focuses on what it can control: stability at home and strength in exports. That's why the Bank of Japan tolerates a weaker yen. It helps Japanese products compete globally, even if the currency itself doesn't carry the same prestige as the dollar or even the euro. But there's another layer to this global game. Currency values don't just reflect economics, they reflect geopolitics. The US wants a strong dollar because it keeps America's financial dominance. China wants to boost the yuan's role in global trade. And Japan? Japan plays the quiet game, choosing survival and steady exports over currency glory. This is why Japan doesn't panic when the yen falls. They know the dollar will remain the king. They know China's yuan is rising, but they also know that by keeping their yen weak, they keep Japanese companies strong. It's not about winning the global currency war, it's about staying alive in it. And that's Japan's strategy in the great money game. Let others fight for the crown while quietly turning weakness into strength. Conclusion: weak but strong. So why does Japan's currency have such low value? The answer isn't as simple as Japan is weak. In fact, it's the opposite. The yen is low because of choices, because of history, because of strategy. The Bank of Japan has kept interest rates near zero for decades, not because they don't know what they're doing, but because they fear something worse than inflation: deflation. They remember the pain of the 1990s, the lost decades, when falling prices froze the economy and scarred a generation. That memory still guides every decision. A weaker yen is the price Japan pays to keep its economy alive. It means imported food, oil, and gas are more expensive. It means ordinary families feel the squeeze in their daily lives. But at the same time, it gives Japan's exporters, Toyota, Sony, Nintendo, Honda, an incredible advantage. Their products become cheaper overseas, their profits climb, and Japan's global influence continues. This is the paradox of Japan's yen: weak on the outside, strong on the inside. To outsiders, the yen looks fragile compared to the mighty US dollar, or even the rising Chinese yuan. But to Japan, weakness has become a weapon. It's the tool that keeps factories running, jobs alive, and innovation flowing. So the next time you hear someone say, "The yen is weak," don't take it at face value. Weak doesn't always mean bad. Sometimes weak is power. And in Japan's case, the weak yen is not a mistake. It's not a failure. It's a survival strategy, a deliberate choice that keeps the world's third largest economy stable in a world of giants. Because in the strange game of global money, strength isn't always about numbers. Sometimes the weakest currency hides the strongest will.